Welcome to the channel. Today, we are conducting a forensic financial analysis of Robinhood Markets. We will isolate the specific mechanical forces driving the recent collapse in its stock price and determine if the market accurately prices its underlying value. This graph plots Robinhood's share price. Following a peak of $154 in late 2025, the stock corrected over 50%, settling roughly at $74. Zooming into early 2026, the damage is concentrated, recording a 35 to 40% year-to-date drop. The root cause of this sell-off is an identity paradox between how the broader market perceives the company and the mechanics of its current operations. Wall Street continues to price the stock almost entirely as a high-beta crypto proxy, a platform whose valuation is tied to retail trading volume. Simultaneously, the company's internal architecture is undergoing a deliberate structural shift. Management is moving the business away from transaction-based trading and toward a stable, recurring revenue financial superapp. The friction between these two realities creates a transitional penalty. The market is pricing the stock for its past, resulting in a divergence between current price action and the company's long-term intrinsic fundamentals. To see how this friction operates, we must dissect the primary catalyst for the recent drawdown, the Q4 earnings report released in February 2026. It reveals several operational contradictions. This dashboard details Q4. The left side shows a top-line miss, $1.28 billion in revenue, short of consensus. However, the right side shows 66 cents EPS and a 42.1% net margin, proving a lean, profitable internal structure. This dual-axis chart tracks assets under custody, the primary metric of platform scale. While total AUC reached a massive $324 billion by January 2026, the specific overlay line shows the metric declined sequentially for the first time in years. The user metrics reflect a similar tension. Total funded accounts grew steadily to 27.4 million, yet monthly active users dropped 13%, falling to 13 million. Furthermore, the average revenue per user has stalled. The underlying data clearly isolates the problem. High net margins confirm the platform is robust and profitable at its current scale. However, shrinking active users and stalled revenue metrics confirm that the legacy engagement model, relying purely on sheer trading volume, is facing headwinds. That breakdown in active engagement exposes Robinhood's heaviest liability. Its transactional revenue is tied to the volatility of the cryptocurrency market. This dual-line chart overlays Robinhood against Bitcoin. As Bitcoin dropped 50% down to the $70,000 range, Robinhood's share price mirrored the collapse. Consequently, in January 2026, total app volumes dropped 57% year-over-year as the crypto market cooled. This stacked bar chart breaks down $776 million in Q4 transaction revenue. The crypto segment suffered a 38% sequential drop to $221 million. Options trading also missed expectations, landing at $314 million, confirming a widespread retail trading freeze. This retail freeze correlates with decelerating net deposits across the platform. Rising inflationary concerns, global geopolitical tensions, and $100 oil prices, reducing retail disposal capital. Compounding the damage, rising interest rates place downward pressure on the $196 million margin trading business. Operating as a crypto proxy amplifies downside risk. It converts global macroeconomic fear into a direct destruction of Robinhood's top-line revenue. The consequence of this revenue destruction is a mathematical re-rating of the stock itself, multiple compression. This table compares Robinhood's valuation multiples, price to sales. Today, those have contracted to 35 and 16, respectively. These unforgiving market forces are mechanically and systematically removing the excess speculative premium from the asset's underlying baseline valuation. Robinhood currently carries a beta of 2.47, a metric measuring volatility relative to the overall market. A value of 2.47 indicates that Robinhood is hypersensitive to market fluctuations, reacting nearly 2.5 times more than the S&P 500. This rapid compression is accelerating under external pressure. Competitors like Schwab and Coinbase are tightening their grip on market share, while regulators continue to scrutinize the payment for order flow model. The high-growth premium has been removed. What remains is a compressed valuation that reflects a cyclical business operating through a downturn. Yet a close examination of the underlying data reveals that this multiple compression ignores the structural engineering happening beneath the surface. This pie chart tracks Robinhood's revenue mix. Stable recurring subscription revenue has steadily grown to 40%, anchored by 4 million Gold subscribers. Furthermore, user commitment is deepening, with funded retirement accounts doubling year over year to hold $26.5 billion. To evaluate operational health without interest rate noise, we examined the core EBITDA margin. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It serves as a measure of a company's core operational profitability. This chart plots fiscal year 2026 consensus projections, $5.5 billion in revenue, and an expanding EBITDA margin of 59%. Supported by $910 million in recent stock buybacks, these strengthening fundamentals drive analysts' average target of $120. The pipeline driving this shift includes new prediction markets, the Cortex AI Insight Engine, a premium credit card, and high-yield banking services. Beneath the volatile facade of our retail trading platform, Robinhood is architecting a predictable financial utility designed to capture the next generation of wealth. We are left weighing two distinct realities. On one side sits the bear case, crypto weakness, macroeconomic headwinds, and a 35 times earnings multiple. On the other sits the bull case, a 59% EBITDA margin and a transition into a comprehensive Superapp. Robinhood is currently in a transitional phase. The market is pricing the company for its past, while assigning little value to its structural future. For short-term faders, the outlook is cautious. The stock remains vulnerable to Bitcoin's near-term swings and broader market sentiment. But for long-term investors with a high tolerance for volatility, the current 50% contraction in valuation multiples offers a potential entry point based on the expected growth. The immediate catalyst arrives on April 29, 2026. That earnings report will confirm whether the retail trading floor has stabilized. If management successfully completes this structural transition, the current $74 price point will reflect a significant gap between the stock's valuation and its fundamental earnings power. Thank you for joining us for this analysis. If you found this breakdown valuable, subscribe to the channel, and we will see you in the next deep dive.